Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. My guest today is Eric Burns, and we're going to talk about his journey from being a firefighter to a capital raiser and real estate syndicator, where he helps entrepreneurs to live life bullish, guiding entrepreneurs on their path to financial freedom through passive commercial real estate. But it all started with a rental property. Let's go. This is episode 252 of Zen and the Art of Real Estate Investing with my guest, Eric Burns. Eric is the founder of Flowers Capital, where they help entrepreneurs establish passive income through commercial real estate investment. He is also a former firefighter turned entrepreneur. Eric, welcome to the show.
Hey, Jonathan, thank you for having me.
Yeah, good to talk to you. And we have had some firefighters on, so I want to start there. When in your firefighting journey did you start thinking about real estate as something that might be a big role later?
Okay, so real estate for me started as a single family residential property, and it started as a side hustle.
Yeah.
So as you probably know, firefighters are big on side hustles and side jobs and stuff like that. So
I got a lot of contractors in there. So a lot of it does have to do with houses, though, for firefighters, because they're always in houses. Was that part of it? Or how did you come upon real estate as something that to be that side hustle?
Mm-hmm. Yeah. So I did the grass company and I did some building construction, and I knew that I needed to kind of get into something a little bit, but none of it really took off like I had hoped.
Yeah.
So I kind of just heard good experiences about a rental property at the kitchen table. And the guy said, yeah, it worked for me. And I thought, hey, this is a great idea.
Yeah.
So I went out and I bought a single family student housing rental. And from the time I decided to buy it to the time I got it was about 3 months. So I just kind of leaped in. And then after that, it was kind of the time to figure out, how do I be a landlord? How do I,
Yeah.
I just kind of took the leap.
What did I get myself into?
Mm-hmm, absolutely, because the guys said it was they approved and they said it was a good idea. And I thought, why not? And so I just kind of started out as a side hustle and just grew from there.
Yeah. Well, how was that though? Did you choose student rental on purpose, or did the property just kind of present itself at the right time?
I specifically targeted student rental. Reason being was the predictable vacancies.
Yeah.
So I could just kind of do the math really easily. It was very rudimentary math that I did in hindsight, but I knew that if I could just factor in a month of vacancy to flip it, to turn it over, then I was kind of like, I was more comfortable with that rather than kind of figuring out what a vacancy would look like kind of in the larger market.
Yeah.
So that's really why I kind of doubled in, and I just wrote, I wrote letters, and I had a letter that I'd write it, I'd personalize it. I wrote the labels and I stamped it and I sent them out. And in hindsight, marketing wise, I had a really good response rate. And I actually found it it was off market and it was in a trust, and they were just trying to offload it and bought really well. And I was, and I enjoyed the construction. I thought, well, I know how to do projects and all that. And it felt like it was a good fit, and it was. So I just kind of took the leap, really.
Yeah, I mean, there's a huge nugget in there for the listeners, because I think that the personal letters are still an absolute win always. And it's something that you can still do. So technology's created all these other opportunities for people, so they pay a lot, send out too many letters, instead of just picking some houses that you really like, that you've walked by, and sending your own real letter from yourself, because then you already have a connection when they call you back, because they're relating to your letter instead of these, postcards, which, sure, I've used as well, but you don't create as much a connection. Did you find that was really the linchpin to that first deal? Like, hey, it's just me. Like, you're getting Eric when you call. You're not getting, we buy houses.
100%. And I actually did that for a couple other properties that I bought as well, because it worked so well.
Yeah.
And you make a great point too, Jonathan. regarding the personal touch. And I think right now, marketing for properties and the text messaging and the cold outreach, we've all gotten a little numb to it.
Yeah.
And I think people from here on out are really going to respond to a personal touch and an authentic connection. And whether it's on writing a letter or making a cold call or reaching out on LinkedIn or anything, to connect authentically first, I think is going to be where we excel moving forward.
Yeah, I agree. You just need that differentiation between all the other letters. If someone's owned the home for 20 years, they're getting a bunch of letters. That's how are you going to be different? Why do you want to send the same thing that everybody else is sending? But how did you even know to do that? Was it just something somebody in the firehouse told you, or are you just kind of being economical about it? Hey, I can write these. It doesn't cost anything except a stamp.
It was economical and it seemed like a good idea.
Yeah, but I mean, it must come from relationships. Obviously, in the firefighting system, you're always dealing with people. A lot of times, at terrible times, things going on. Obviously, fires happening. You have to be good with people. Did you take all your people skills that you got during that, translate them to real estate as you started to grow?
Mm-hmm. I did, and I actually kind of used my leadership skills from the firehouse, being a lieutenant. With my first set of tenants, they were horrible, and in hindsight, they were my first group.
Yeah,
and I didn't realize how horrible they were. And they were college boys, and they were funny, and I liked them, and they would try to pay me, in partial payments, and I'm going, guys, like, we know we don't do this.
Yeah,
and I felt like their teacher, and I felt like I was like kind of, having to get a little stern with them at times, kind of lead them through life a little bit. And I'm like, oh my gosh. And then the tenants I got from there on out were actually really good. And I brought a level of customer service to them as well. And I had I really didn't have as much turnover. So if I got a group in, usually they stayed for their junior and their senior year.
Yeah, nice.
And that was really nice. So being able to have a personal touch and deal with people and just respond in a timely manner. If you're a landlord, it is a job. And if you treat it like a job, you need to kind of treat your tenants with a level of customer service. Yeah. And that goes a long way for tenant retention.
Yeah, I completely agree with that. And I also think you made a great point. I think you become part parent when you're doing college rentals because they just don't know stuff. Like they don't know how the air conditioning works. They just things that we think they should know. They lived at home, then they went to a dorm. They didn't have to figure out, they don't understand like what happens. Hey, there's a breaker off. You're like, oh, we'll just go down to the box. They're like, what's that? They just have no idea. And I think I was that person, even though I grew up with a dad as an investor. I remember in college, like the basement flooded. It wasn't our fault. The hose just came out of the washer and we were away. There was like 2 feet of water in the basement. We're like, I don't know what to do. So I called my dad, but as a landlord, it wasn't our fault. So it wasn't like we did anything, but you do have to be kind of like a little bit parent, but that helps you kind of learn, as you were saying, to create better customer service because they need a little bit more than a lot of tenants.
Mm-hmm. Yeah. And responding in a timely manner is huge. And that got me that was kind of the lesson I moved into my other, I started renovating duplexes from there on out. And when I was dealing with more tenants, responding in a timely manner, even if it's something silly like a doorknob, it matters.
Yeah, definitely.
And you mentioned, it's never the right time for a fix.
Yeah.
And a doorknob is going to take up an afternoon because it's going to be, a 10-minute drive to Home Depot. You never get out of Home Depot in less than an hour.
And always forget one thing that you really need. So it's got to go back.
Yeah. And so, so a 20-minute job takes up, 2 hours of your day.
Yeah.
Or you're out of town or anything like that. But to really care about your tenants on a customer service level. And it actually helps as well when they know you care, then they're more likely to tell you when something's wrong.
Yeah.
And I always, and you really need to encourage that behavior and that dynamic with the tenant, because once they know that you want things to be right, they're more likely to tell you when things are wrong and they don't snowball. And the worst thing for me is when a tenant would not tell me something, and then all of a sudden it's a bigger problem than it had to be. Then, they'd say things like, well, I didn't think it was worth bothering you. And I said, well, I want things to be right for you. You're paying to live here. I want things to be right for you. So you need to tell me. And then, I had one tenant in one of my duplexes, I think for 4 years, and they were amazing tenants. I had figured out the screening process by then.
Yeah.
And they were really great. And so not every tenant experience was a bad one. A lot of them were good.
Yeah, as you were talking, I was thinking about this, and then you said it right away. Your time of response as a landlord is directly proportional to how responsive the tenant will be when things come up, as you were saying. And with water, that can be a big issue. They may have a slow drip that becomes mold later, and because you told them, hey, don't bother me if it's not an emergency. Now they're not telling you about other stuff, and then they move out, and you're like, whoa.
Mhm.
This isn't what I expected. So I really think that's an important point for new landlords to understand. I was fortunate enough to grow up with a dad who was a landlord, so he taught me how to be a landlord, to care about the people. But I think that's really what makes you get less maintenance requests. If you are annoyed when someone calls with a plumbing problem, you're going to be the one who has an overflowed toilet because you're not going and reacting right away.
Yeah, you can be annoyed. You just can't act annoyed.
Yeah, right. I mean, of course, we all know that a toilet problem comes up on Thanksgiving. That's just what happens. That's the kind of the thing of rental properties. But how did you enjoy overall being a landlord at that phase before you got into larger products? Because some people grow to really enjoy it. It sounds more like you did. Some people just hate it. That's me. Because I don't really want to be the person to respond. So we had a property manager for all of our properties in New York. That helped us dramatically, me specifically, because at least there was a buffer in the middle for me.
Mm-hmm. And I don't know if you'd agree with this, Jonathan, but even with the property manager, it's still a job.
Oh, absolutely. Yeah.
And where I grew out of it was in one of my last couple renovations. I was covered in drywall dust, and I had just been working my butt off on my off days, and I was exhausted.
Yeah.
And I realized I was only trading my time for money, and that was what led me to kind of lean into commercial.
Yeah.
And I love learning, and it was and the listeners know it's a rabbit hole. You go down the real estate rabbit hole.
Yeah.
So I enjoyed being a landlord for a while, and when I grew out of it, it was really, I was pretty burned out on it, and it wasn't the lifestyle that I was looking for. So for people that enjoy it and enjoy that product, it's more accepting a lifestyle that you want. And so some people really thrive in that. For me, the idea of being able to get things passive, to be able to scale and really kind of and go that route was very appealing.
Yeah.
So when I was like, I was actually in a mastermind, one of my first masterminds, and a lady in the group was actually from New York, and she had been talking about commercial. And so this was shortly after I kind of realized I was having an issue with my time, and I actually kind of did the math in my head, and I thought, man, I'm working this many hours for and I'm making this much money. I'm like, oh my goodness, my first job was when I was 13 in like the 90s, and I think I was making more hourly then than I was on my renovations for sure. So she said, well, if you're interested, lean into this guy's content and go from there. And so I started following this gentleman, Mike Ely, and it turns out that he and he's still got great content he puts out. So that was my next mastermind. That was my first commercial real estate mastermind.
Yeah.
And it turned out just by happenstance, he's local to Cincinnati.
Oh, wow.
I called a friend of mine and I said, hey, do you know anything about this guy? And he said, oh, I know him. He's a friend of mine. I have lunch with him every Friday. And I said, all right, well, it sounds like I know my next move. And that's kind of my story, is just kind of doing the next right thing that made sense. And that was my new thing to go down, and just loving the learning process, whether it's real estate, whether it's fly fishing, whether it's anything like that. Just learning something new is energizing.
Yeah.
So kind of the more I leaned into that product, the more I kind of really got to where I felt like it was the place to be for me.
Yeah, I think a lot of people who start in single multi and small multifamily get to the point where they're like, yeah, this is a full-time job, and now I have 2 full-time jobs. So they figure out the way to scale up. But you sought masterminds and other help to get you there, which I think is super helpful. But it is a little bit harder now because there's so much content out there and so many false classes, good classes. It's hard for new people to kind of know which one, but you did get that personal reference, which I think really helped, which is something that the listener should really look for. Can you have someone within your circle or circle of circles that can verify, hey, no, that's a good program. You're going to be money well spent there.
Mm-hmm. Yeah, 100%. There's good ones and bad ones. Do your research and make sure that the person you're looking to learn from is a person that you want to emulate. For one, that their content is robust and that they've done what they say they've done. So the mastermind I'm in now is actually solely for capital raisers. It's a little more focused. It's called Raise Masters, and Hunter Thompson actually wrote a book on raising capital. And I loved the book. And I thought, man, this seems like a great fit. And I got to know a couple of the guys that were in his company.
Yeah.
And I really kind of realized it was a good fit. And when you're choosing a mastermind, I always like to kind of make this point. Usually you're going to be learning, you're going to be starting at the bottom of the learning curve. So, and a mastermind steepens that curve so much, and even more so. And I always joke, it's like, there is totally dumb questions to ask.
Yeah.
But the what you need to do is find a group that you can be humble enough to ask them, for one. And when you ask it, they don't make you feel like an idiot.
Yeah.
They really kind of encourage that. And then you found a good fit. And your network is your knowledge. And that's really what I gained from the mastermind: support, accountability, and knowledge.
Yeah, I found that the most important part of paying for any mastermind is the people. The content's generally going to be good. Even the bad content's pretty good. It's recycled from somebody else, so it's not completely off base. But everybody's magic comes from the people they meet inside the program. So they take the learnings together. A lot of those turn into partners, future deal makers, and things like that. Have you found that? Because you seem to be very invested in masterminds over time, that these are still people that you contact with and alternative ways to do business later on.
Absolutely. Most of the operators I work with now and I raise money for, their deals, I know them on a personal level from a mastermind first. So the way I actually work with operators is I usually know them on an organic level. And then from there, I kind of know there's somebody I'd like to work with. And then I evaluate the markets they're in, then I evaluate the deals they're in, and things like that. But generally, they're people I want to work with and I know. So the market, they're great operators. They're already working in great markets. That usually takes care of itself. They're getting great deals because they're great operators. That usually takes care of itself. And the biggest part, and I think people are starting to kind of double back and really kind of be more careful and a little more diligent about who the sponsor they're looking to work with. And I'm very proud of the base of sponsors I use, and I'm very confident in their abilities. So the biggest part of the vetting process is that sponsor, and even sponsors that are good sponsors. With the way interest rates hit us, the last couple of years, they hit tough times, and it doesn't make them a bad sponsor. But how they handled it is kind of the crux. Like, that's what you want to know. And are they standing up when times are tough? And I know I work with a lot of operators that navigated that situation perfectly, and are really buying well now, and they're buying at discounts, and they were disciplined. And I know some other operators that are good, and they're just making right on their deals to their investors, and they're not really walking away with much, and they're putting their investors first as much as they can, and that's important.
Yeah, and the transparency in the process becomes really important, because for a lot of LPs, whether depending on how many times you've been an LP, you don't have any control. But what you want is the transparency to understand in that monthly, like, hey, what's really happening, especially when there's been some issues over the last couple of years, a lot related to debt or construction stoppages. But I'd just rather know up front and not get the capital call notice, to just say, hey, we messed up here, give us some more money, please. That's not, I don't want that at all. I want to be, 6 months ahead of that.
Yeah. And then if you're getting a quarterly update and something is wrong in month 2, then say, hey, we're hitting a snag. Here's two ideas we think we're looking into to solve the problem and right the ship. Just be aware that, there's ups and downs in any deal, whether in any asset class, there's going to be ups and downs, and say, hey, the NOI might be a little low here in the next couple of months, but here we're looking to kind of lower expenses in this area and make up for it, whatever it is. But that transparency and just being upfront about, not only is there an issue, but also come with a plan to solve it right away.
Yeah, I mean, then you feel comfortable as a limited partner. I don't think you just, you don't want to be surprised by something that you should have known before, or feel like you're kind of getting tricked or suckered into something else. And I think that's where again, building the relationships, and for you, making sure that your box of sponsors that you like to work with is, pretty tight, and people get in there if they've proven themselves, And if they do something, they may go out of the group. But you made a good point. Not every sponsor who's having issues over the last year and a half is a bad sponsor. Some deal was okay. The asset's still good. They just kind of have to reposition capital to make sure that they can cover, especially for those construction ones that also had bridge debt. I mean, that's a big problem.
Yeah, that bridge debt was getting a lot of people, and in hindsight, it was kind of a necessity almost, or such a strong draw to do it, because if they weren't taking bridge debt, then they were having a hard time getting any deals.
Yeah.
And when they're underwriting, they're still underwriting for, they're still stress testing on an increase in the interest rate, but when they went so high so fast, it's kind of going, oh no.
Yeah.
And I don't think anybody, whether they were taking bridge debt or not, would have said, oh no, I'm not taking bridge debt because I think the interest rates are going to go crazy. I think they weren't taking bridge debt because it wasn't in their, kind of buy box.
Yeah.
It just wasn't finance. It wasn't debt terms they were comfortable with.
Yeah, I feel like the most experienced syndicators weren't trying to force it. They know that the debt's important and they've done enough deals. You've gone full cycle 20 times. You don't really need to get another one. You have to be okay with maybe only finding one or two deals, last year. And those I feel were more solidly played than others. And some people are still doing fine. I'm in 3 as an LP. They're all doing okay, one a little less than the other 2, but no problems. I'm not experiencing any problems. And I think as an LP, I really combed over the data that I saw. I like the asset itself, and I like the debt. They were all fixed debt, which is really important to me.
Mm-hmm, absolutely. Yeah, I love, fixed debt's important to me as well. And to make sure that business plan is executionable, and kind of hearkening back to where we are being transparent and as a capital raiser, I feel like I'm an advocate for the investors.
Yeah.
And I'm kind of an in-betweener, but I'm an advocate for the investors and a steward of their money, and to make sure that they are in the know is very important. And just say, hey, this is your money, and there's some things going on, but we're trying to fix them, and it's a responsibility you have, I think, to be transparent. And when you're evaluating deals, like you said, to make sure you're comfortable and you understand the debt terms and you understand the business plan, especially.
Yeah.
And then say, is this business plan something, or the reserves and the CapEx and, the bigger levels like the rent increases and things like that. So to make sure that you believe in the business plan and the levers being pulled, and make sure it's not overly ambitious, and, and you were saying, be okay taking a couple fewer deals. The one operator, we just closed a deal. I just worked on a deal with them in February. We closed, and they had waited 14 months for a deal, because they were super disciplined, and now they are poised to do really well in a really great market. And it's really a neat thing to say, to see somebody just hold fast. It's it's kind of like, okay, like, it's okay to be patient. It's okay to wait for a single and a double, and now's not the time to go swinging for home runs. And
if you wait, you may get a home run. It may just get to the, with the new bats, it may just get to that giant part of the new bats, and then you're all set. But yeah, I think it makes sense, and I think it's a learning lesson for everybody who's involved, about vetting deals. But when you're a conduit like you, if you're taking someone and then you're bringing them the deals, it's also a different mindset, because your risk tolerance doesn't necessarily. You may like this deal, and your risk tolerance may say, hey, this is fine. I've been doing this a long time. But each investor who comes along may have a different level of risk tolerance that they're comfortable with. So not all deals may work for them. Has that been something that you've had to learn over time, that, hey, this deal looks great to me, but that doesn't mean it's good for, Bob Smith over here?
Absolutely. And I come with deals and a product and deals that I believe in, that I like. And I know investors sometimes, they pass. It's just not for them.
Yeah.
And you just have to be understanding that when you're raising money for a deal, they have different tastes and they have different risk tolerances, and just be respectful of that. And then from there, just take it and understand, investor A, he was okay with this, so he likes that kind of deal.
Yeah.
Investor B, maybe his hang up was in this area. Maybe the CapEx budget was too small. So he to make sure that when you bring him another one, say, hey, you had a problem with the CapEx budget. And this is actually a real example.
Yeah.
He didn't think that, I had an investor didn't think the CapEx budget was so high, and he underwrote that thing, to a T.
Yeah.
And that was his thing. And I said, and he wasn't comfortable with it. And I'd rather have an investor come in comfortable with a pass on a deal they're uncomfortable with.
Yeah, for sure.
Come into a deal that they're uncomfortable with, because, and I like saying this, passive income should be fun, and it defeats the purpose of going passive if you're stressing over a deal. The point of passive income is that you set it and forget it.
Yeah.
And, when you're stressing over a deal and, when you're not comfortable going in, you're kind of setting yourself up for, 5 years of kind of stress, having it on your mind. And that's not what we want.
Yeah.
Find the right deal for the right appetite and go from there.
Yeah. And I've found that as a lot of people who are active as investors for a long time, when they get into passive, because I know you're also interested in the mindful part as well, I really think that you have to have done some self-analysis to understand when you move from active to passive, like you're giving up a lot of control. So you can't be a control freak when you get to passive. That was a thing for me. I was active my whole life until last year. And then I was like, syndications, interesting, specified turnkey. This stuff's starting to sound a little more interesting because I don't really want to do any of the work myself anymore. I'll do like one flip here and there. That's not a big deal. But like high volume, I have other stuff to do. I've been doing it too long. And I met so many people who were so good in syndications that I realized I'm never going to be that good. So I need to trust people. But don't you think there's a lot of like self-work that needs to be done? Because you can't act like an active investor as an LP. No one's ever going to want to take your money anymore because you're annoying. You're supposed to be, silent partner passive.
Exactly. Yeah, and I think it's a perspective. And for me, and just like you, and that's why I do solely raise capital. I went to, when I started out, I was sourcing deals and working with brokers and lenders and all this sort of stuff. And I was raising money for a GP I had put together. And I realized I was like, okay, well, I really need to work on my capital raising skills. And so I look around, and the people in my network that I already knew were so much better at operating.
Yeah. Interesting. Yeah.
And they were looking for people like me to raise money for them. And I thought, what a great way to be able to, I don't want to say leverage because it's more of a partnership.
Yeah.
But really kind of partner and with the right people where they can do what they're best at and I can stay what I'm best at. So I think it's a perspective to say, well, am I giving up control or am I delegating the parts that I'm not great at?
Right. To someone who's way better.
Absolutely. And to see the high level premier operators go.
Yeah.
I'm going, whoa, dude. These guys know way they're light years ahead of where I would have been.
Yeah.
So, and when you're taking other people's money, frankly, I trust those operators to deliver better than I would trust myself to operate.
Yeah, because as you said, they've done more deals, they get it. And I think that's really smart, a good self-analysis by you to see what's out there in the industry and say, hey, I'm really good at this middle part. Let me just work this middle part and build all these relationships. And I love the word that you used before, and that's stewardship, because I find that to be really important. You're bringing and taking care of someone's money to put into a deal with someone else who you vetted. So you are both parties, you have a double kind of fiduciary relationship, which is important because both parties you want them both to be satisfied. And if something starts to go wrong, you want to be the person in the middle who can say, hey, look, this is all good. We were on the up and up, as we were talking about before.
Mm-hmm. Absolutely. And when I'm doing investor relations, to make sure that I remain available too.
Yeah.
Just like dealing with the tenant, to make sure that I'm available to you. If you have a question, that you need to make sure that I need to make sure that I'm accessible. If I'm taking your money and I'm being a steward of your money, then you deserve the reciprocity of where you're trusting me with that. Then you need to know that I'm taking it seriously and that I'm here to answer your questions.
Yeah, and I think the most important thing I've seen from good syndicators and capital raisers is they know when someone's newer to the process as an LP, and they know they're going to need a little bit more handholding. When you cut that first $50K or $100K out, you start to get nervous. It's like when people buy a house, they're fine going through the process. And then they get to closing day and they're like, oh my God, like, I don't know now, what am I going to do? Or they win the offer and they're fine. Now they don't want it. It's like once somebody says, okay, it's the day, you have to upload and send the money now. People start to panic. Oh, you sure this is a good deal, Eric? What am I supposed to do? So those first timers, they need a little more. But if you do a good job at that stage in creating that relationship, that could be 10 more deals. They're just going to keep rolling the snowball over and over.
And you make a great point, Jonathan, about growing with your investors, educating investors that may want to learn a little more, that are less experienced.
Yeah.
And when I started capital raising, it wasn't out of like a desire to do so. It was out of necessity. And what I viewed it as was going out and asking people for money. And what I found out is really, it's not. It's marketing. And if you have a brand and you stay authentic, then it's just marketing. And one of the things I like the most about it is writing content and writing educational articles and things like that, and being able to take that to investors and say, oh, well, if you're not familiar with how a syndication works, I wrote an article on this. If you're not comfortable with, if you're not sure what the metrics are, really trying to explain to you, then I have an article on that. And to really prepare them for that first investment. And if they don't go with the next deal you have, they might not be ready. And the next deal they have, they might be on the fence. And then that third deal, they're ready to invest and they're prepared to invest. And that really makes where I feel like when I take on investor money, I'm really taking on a partner as well.
Yeah, I mean, I think that's just smart marketing and also very time efficient. I've always been an efficiency freak. And so I make a ton of videos instead of blogs. And so in the on-market world, if somebody says, oh, I don't know what to expect at home inspection, I'm like, well, here's a home inspections playlist. Watch all these, then send me the questions. They usually don't have any questions. So you can keep pointing to them the content, which again reaffirms their trust in you by saying, oh, wow, okay, that was exactly what I wanted. But I think it's a great thing. Then you just build the blog once, you get that question 10 times. If you're involved in real estate and someone asks you a question twice, just like if you're a short-term rental host and somebody brings up something like, hey, you don't have a pack and play, like get a pack and play, write the blog, because it will save you from having all those conversations. And then the conversation that you have after the blog is usually much, much better. And as you're saying, much closer to a conversion later, because you're building trust while you're doing your own work because you built out content that delivers it.
Yeah, absolutely. And like, and writing the content, making the videos, it's fun. Educating people and sharing your experience and your knowledge is fun. And so that is actually one thing I do enjoy about capital raising that I didn't think I would.
Yeah.
So when I started going down that road, I really started enjoying it and really, really happy I niched down.
Yeah, and I think it allows people to do the research in their own time without having to, go down a rabbit hole on YouTube, which is fun, but it could be 2.5 hours later and you're still watching movie previews because those are great, but you didn't get to the thing that you wanted because the first thing that came up wasn't exactly it, and all the recommendations were based on past stuff that you wanted. So it's just smart movement. Hey, it's Jonathan. I hope you're enjoying this episode with Eric Burns of Flowers Capital. And if you're thinking of going big, like Eric did from the beginning to the end, and you have to figure out what to do with your money and how to save money on taxes, you might want to check out my friends at Hall CPA. Now, you can use my link at go.therealestatecpa.com/Zen. And when you get there, you'll be able to do a discovery call with Hall CPA, and they specialize just in working with real estate investors. Let's get back to Eric. How was it when you first started asking people for money? Because that's a real leap for everybody when they get out of active, hey, I've just financed my own deals or done them with friends or partners that I know. Now I need to raise money either for myself or other people. How did you get over the hump of really, just being nervous about it, or were you nervous?
It's a little awkward at first. I think it took a perspective change to say, I'm not selling a product. I'm offering the opportunity to see a good fit.
Yeah.
And when I started looking at it like that, it wasn't necessarily going out, knocking on doors, begging for money. It was just presenting an opportunity that I already believe in. So I'm already selling a product that I like.
Yeah.
So that goes a long way. And it's a deal that I believe in to the point that I would take my own mother's money and put it in, which I've done before, things like that. And which ironic, which is funny. They say, the co-investment thing, and, putting my money in a deal, my risk tolerance is a little higher.
Yeah.
So,
yeah.
But taking your family's money is a lot bigger responsibility.
Yeah, that's a bigger stewardship, because like you're going to have to sit around at Thanksgiving when it went down like 1%, you're in trouble.
Yeah, you can't break mom's heart, man.
Yeah. Well, that opportunity part is the real big mindset shift that I've found across my own history and plenty of other investors. It's that first you think that you're trying to get something from someone, and then you realize, wait, now once you present an opportunity, you're like, hey, if you don't want it, somebody else is going to be interested. So there's that timeliness fashion too. But I think no matter what you're doing in real estate, when you're able to walk away from the table and say, hey, if it's not for you, that's fine, you earn so much more credibility than all the hard pushes out there in every part of real estate. Once somebody knows that, if you like it, great. If you don't like it, great, I'll send you the next one. I think that just makes it better, because I don't think anybody likes a hard sell anymore.
No. And I hate hard selling. I had a job out of college. I had a job out of college where I was working for a mortgage broker years and years ago. And it was a hard sell cold call. And I did not like it one bit. And it is still awkward when you kind of get to know someone and you have connected with them and you think they're interested in investing. And you say, hey, do you want this investor call or not?
Yeah.
Because you feel so salesy. And it is important to just kind of sit back and remember, LP positions aren't for everybody. They might have other investments. They might be heavily invested in buying businesses, or they might it just might be out of their comfort zone right now. But to offer it up and just make the offer to, get on the phone and just let them know that this is as much to learn about what you want out of an investment, rather it is for me to pitch you a deal. And that's why I really like connecting with investors before I have an actual deal, because then I don't even have anything to sell.
Yeah.
And then they don't feel pressured and to let them know that, say, hey, even if this isn't the right one, I'm happy to just go through it with you and show you the process and just kind of, walk them through. And if it's the right time, then it's the right time. And if it's not, it's not. And respect the investors, the decision to say no.
Yeah, absolutely.
And respect the no and don't take it personal and things like that.
I hope not. I mean, what is it? If it's personal, I think you're doing it the wrong way. But I think people need those reps. So going through a few deals, looking at a couple of PDFs of what it all looks like is helpful, because then you build up the confidence. Hopefully they meet a couple other passive investors. That's one thing, though, that I think has been an interesting shift over the past couple of years. Now there's a lot of groups of passive investors, which I think helps. They weren't around when I was younger. It was all active investors, and there was no internet, so it was still a smaller group. But now I really feel like if you want to invest passively, you need to talk to people who invest passively as well. So I'm kind of happy that I do it now, so I can really say, like, no, syndications, it's not, it's not fake. Like, it's actually cool, but it's illiquid. So like, that's usually where I start. Like, don't do this if you think you're going to want your money back, because what used to be 3 years maybe is 5 years now, 5, maybe 7. We're not sure. Depends on the operator. A lot of things can happen. And I guess in theory, it seems like it's less risky than active investing, but there's risk involved in all parts of real estate, even though I find it to be very limited. And as my risk tolerance is very high in real estate, because I feel like I know what I'm doing.
Mm-hmm. And you make a great point with, being able to look and have more access. And people think the syndication, well, it sounds nefarious to begin with. You want to do a syndication?
Yeah.
And they go, whoa.
I mean, it's a crime organization, is the other opportunity for it. So you're like, oh, okay.
And it's like, hey, it's just a word they describe. It's SEC regulated, and it's not as nefarious as it sounds, and things like that. But and with the rise of the internet and the way we can connect so much easier, it's a lot more accessible, and we're still kind of catching people up to where they're kind of still, they might not have been exposed to it quite yet.
Yeah.
But they've been, and in the past they might not have even had access to it as well. So now we're getting more access for people, and we're able to kind of spread the word and say, hey, these are great investment opportunities. And back to where you said it's a liquid, that's one thing I let people know, like my FAQs and right away. Say, hey, especially when I'm, dealing with somebody that's never done one, it's like, hey, just to let you know, like, one of the hangups that, one thing you need to consider is going to be a liquid for 5 years.
Yeah.
Like,
Don't ask for it back.
You're going to get, you're going to get distributions, you're going to get all this, but you got to be comfortable tying that money up for 5 years. And I always kind of describe it from my experience, kind of going from residential rentals to syndication and I have an article I wrote on it actually. And just to kind of put it into perspective is, for me, the feeling I have at this point is that $50,000 can go out and put me a down payment on a nice rental property that'll cash flow me, but it buys me a job. Where a $50,000 investment in a syndication passively it really starts building up kind of that passive income and, the depreciation and the net worth and all that sort of stuff, tax advantages that come with it as well. So you can really get the advantages without being able to do that. But at the same time, you're committed. You're not, if you get jammed up and you need money quick, if you think you're going to need money quick in the next 5 years, it's probably not going to be a good fit for you. But if you're looking to take advantage of the great benefits that any real estate product offers and not have to do the work, then it really is a great fit.
So when you're looking for sponsors and deals, do you have any preferences either geographically or asset class wise, or is it really presentation of the people that you know?
It's absolutely the people I know. The asset classes and even any asset class outside of multifamily is because I know the operator and I believe in the operator. One of those examples would be a mobile home park developer that I know. And he's got an amazing product and it fits in, and he's got a model where it fits into affordable housing and it's just great in a lot of ways. But the reason I even look at that asset class that I'm not as great at is because I know that operator and I know him to be a genuinely good person and genuinely care about what he's doing. And he's a great example. And he actually operates in North Carolina where they've had the problems and they need housing really bad. And his product provides that in an affordable way. And it's because he believes that, and it's something he wants to do. That's his way of impacting. And so it's neat in that way. And honestly, capital raising has been hard lately. And right now I have really dialed back to kind of my bread and butter and my, and my just go-to asset class, which is commercial multifamily. And I think there's a lot of great opportunity there. People are going to be buying well right now.
I agree.
There's a lot of great markets that have strong fundamentals. The deal we just closed was in Phoenix. They have great, really their employer base is just, their population is expanding.
Oh, yeah. That's not stopping.
They had a $65 billion semiconductor plant go in. After we closed in February, 2 weeks later, they announced another $100 billion going into that project. And they're hitting peak supply now. So Phoenix is one that I just closed, and I'll be looking to do more deals in Phoenix. There's some other places that I have operators that and I'm in Cincinnati, so there's some stuff around here in the Midwest where I know operators, and also in Texas. So it really just depends on where my operators are looking at deals, and then I'll evaluate the market. But the one that stands out to me off the top of my head that I'm bullish on is absolutely Phoenix and a few others for sure.
Yeah, I mean, Phoenix and Arizona in general is pretty weather resistant, other than being just gigantically hot, sticking your head in an oven. That's how I describe it. But hey, people like it. But yeah, weather's obviously going to play a big role over the next few years as things get worse. No one expected these floods in Asheville like you were talking about. So it is interesting to work on that. Is that something that you're considering now as there's more just weather issues that pop up than there used to be, it seems, even though I went through what seems like hundreds of hurricanes as a kid?
I think it's just something to go in and have an eye on to evaluate. So this is in the Sun Belt and things like that. People are saying, "Oh man, the insurance and the hurricanes and da 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 da." There's still a lot of great deals there, but go in and understand that insurance is one of your bigger risk factors there. And Phoenix actually has more predictable insurance costs, but they're actually and to look at to say, what's the state doing are they landlord friendly? Are they, multifamily friendly? And as an example, Phoenix has a 5% increase on their taxes. So they every year they'll only raise the taxes on you 5% a year. So it becomes very predictable, very stable. Combined with the increase, a lot of Californians are moving in there now and things like that. So make sure your demand drivers are there and your supply is in line. And if you're going somewhere like the Sun Belt, and there's still a lot of things to love about these markets, but insurance is going there. The insurance companies are hurting. just to make sure that you're comfortable with the level of coverage you're getting.
Yeah, exactly.
And to make sure it's just kind of a risk that you're okay with, and make sure the returns are reflecting that.
Yeah, it makes a lot of sense. I mean, there's always something new to consider each year. Now we're recording this in April. This will come out in June. Tariffs are playing a role in the construction part of some, but it changes every day. So none of us have a crystal ball. So you just always have to be looking. And as you're saying, it really is on the operator to be doing the due diligence to make sure that the sheet incorporates, best case scenario, generally better, worst case scenario, so that you have a lot of buffer room to do well on the deal.
Mm-hmm. And to make sure that you're personally comfortable with the stress testing, and to make sure that you can say, if there's an issue that you may be concerned about, that that's another thing to say, hey, we're cap rates may be, we were kind of not 100%, I'm not 100% sure that, we're not going to compress or decompress or whatever it is, and say, if we're a little off, we're still going to land in a worst case, we'll be okay.
Yeah.
And and a lot of times responsible underwriting, you'll see the exit cap, which is the other huge lever in a deal, to make sure that you're coming in at a exit cap rate that is going to be achievable or worse than you're going in.
Yeah.
And just not into underwrite. And when you're doing that, you're going to miss out on deals, but you're also going to get a lot more peace of mind, and a lot more stability, and a lot more, and just a more solid deal if you're really being patient and taking that into that account. And when you're looking to make sure that you're not getting too aggressive on, the market outlook, and not too bullish on rent increases, which I'm not at all, for many reasons in any market right now.
Yeah, I agree.
But, and with the tariffs and all that, and it really is a wait and see, whether you're in the stock market or whether you're in commercial real estate or anything, not to freak out, to just ride the wave. It's going to be bumps in the road and everything. And I personally don't like the volatility of the stock market at all. And truthfully, when I was at the fire department, I would see people that would come up on retirement, and they were ready to retire and they needed to make draws, and the stock market had plummeted, and all of a sudden their 401ks are bottoming out at the exact wrong time, and they didn't have anything else to fall back on. And I 100% would never say, take all your money out of the stock market and put it into commercial real estate.
Yeah.
I would say that make sure that you have diversification to the point in your, and this is nothing against a financial planner, but a lot of them
they don't like real estate.
They do not like real estate at all, and they don't make money on real estate.
Yeah.
And to make sure that you have money coming in that's not subject to that volatility of the stock market.
Yeah.
And every investment is going to have ups and downs, and real estate is historically a lot more stable.
Yeah.
And that still goes up and it still goes down, as we've seen. And I think we're at the bottom of the market, and I think we're at a point where opportunities are going to really be increasing, and it's a great time to buy. And ironically, investor sentiment is still very low.
Yeah.
For good reason. People are skittish for good reason.
Yeah.
And to say, hey, and just, when their comfort level, when the investor comfort level reaches equilibrium with what we got, I think we're going to have great deals for them.
Yeah, I think so too. I really think that it's if you're an investor, a long-term one, you're always looking. You just, as we were saying before, your ability to say no to deals will help you say yes to better deals in the future. So, but you just can't stop looking, because you never know when the good one's going to be right in front of you.
Absolutely, absolutely, and to just kind of realize where you're at in the market cycle, and we took some hits, and that's investing. That's anywhere investing, but when you hit the bottom, opportunities start presenting themselves, and you're back up on the upswing. So
yeah, if you could give one piece of advice for a skill that somebody would need to be good at capital raising, what do you think would be something important that we might not have talked about?
I think being disciplined in who you're willing to work with is one, and I think being patient and with the investor is another one. To not rush an investor, and just make sure that you're being patient, and that you're, and for me, it was something as important, like I mentioned, is growing with an investor and looking at it as a long-term partnership. and being patient with the investor or potential investor on where they are in their journey as well.
Yeah.
If they're not there, then they're not there, and just being respectful of their space and being authentic and truly, and just truly making sure that you're not bringing a deal because you're chasing returns yourself.
Yeah.
That I need to be disciplined. And when I look at deals, and I think that's a skill that's very important.
Yeah.
And that might be my main one, is make sure that I'm looking at deals critically and that I'm not chasing returns, because people can get caught up in that and say, well, you've got, a 16% and this other guy's got a 19 and I'd rather do that one. It's like, whoa, how, and especially like an internal rate of return, it can be manipulated. It's like, well, how are they doing it, for one?
Yeah.
So I need to go in and look at very critically with a critical eye at the deals I'm looking at. So when I come in, it's a deal that I believe in. And I think that goes a long way for investor trust, where they after time, they'll see that I might be passing on deals that aren't, that the business plan isn't really, it might be a little ambitious and, and that's why the returns are high and things like that. And there's a lot of them out there.
Yeah,
even
for sure.
Mm-hmm.
Yeah, I think that's great advice. All right, Eric, where is the best place for people to get in touch with you? Is it at flowerscapital.com?
Absolutely. flowerscapital.com. There's actually a free piece of content. So go ahead and click that and grab your 12 pitfalls to avoid in your next deal.
Yep, I see it. So if you go to flowerscapital.com and you look in the upper right, you're going to see a box that says avoid these 12 mistakes. That's your free content there. Click on that. You will get that. Don't fall in the potholes that we have. Take Eric's advice. Well, I really appreciate you spending the time. Really enjoyed it.
Yeah, thank you very much, Jonathan. It was a good time.
Yeah, all right. That was Eric Burns. He's the founder of Flowers Capital. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 253 of Zen and the Art of Real Estate Investing. I got two guests coming in, the hosts of the Wealth Juice podcast, Ryan Bevilacqua and Corey Jacobson. What they do is help you invest in real estate without sacrificing your career, and they're still pretty new to the game, but they've been crushing it. And they go over their strategies, what it took to get them from just starting out, probably like a lot of you, even if you remember how it was in the beginning, and to where they are now. We'll see you next episode with the guys from Wealth Juice.